Most people want to buy the rocket. I would rather own the rails. That is the cleanest way I know to describe what happens every time a giant, headline-grabbing company approaches a public listing. The crowd sees the brand. The crowd sees the celebrity founder. The crowd sees the valuation, the hype, the countdown, the talking heads, the opening bell, the first spike, the first fear of missing out. The crowd wants to touch the object everyone else is staring at. I understand the instinct. It is also the instinct that usually leaves people late, emotional, and overpaying for the most obvious part of the story. I have never made my best money buying the obvious object at the height of public fascination. I have made much better money understanding the system that object sits inside, then buying the critical pieces before the crowd realizes those pieces were essential all along. That is how I want you to think about SpaceX. Not as a lottery ticket, not as a celebrity stock, not as one more chance to brag that you got in on the hottest listing of the decade. I want you to think about it as a validator, a giant validation event for a much wider private-to-public space economy that has been quietly assembling itself for years, while most investors were still treating space as entertainment. That is the real opportunity, because if SpaceX comes public at anything close to the kind of valuation the market is whispering about, it does more than create a new ticker. It tells every large institution in the world that space is no longer a science fiction side pocket. It is a legitimate capital category that shift matters far more than people think. The stock itself may be exciting. The capital migration around it is where the wealth usually gets built. That is the first rule. When the market becomes obsessed with the rocket, you should start studying the launch chain. A launch chain is everything that gets paid before, during, and after the launch. The launch provider, the satellite builder, the communications layer, the lunar hardware, the imaging network, the in-orbit manufacturing and infrastructure firms, the service contracts, the engineering firms, the logistics layer, the mission support stack, the rails. That is what I want to talk about. Because there is a very old pattern in markets. The object that captures attention often arrives last. The money that seems early is often late. The best asymmetries usually appear while the crowd is still distracted by the event and not yet thinking through what the event will validate. SpaceX is not merely another company coming public. It is the most advanced commercialization of a decades-long public to private migration in the space economy. Governments have been nudging, subsidizing, deregulating, outsourcing, and gradually stepping back from being the sole direct engine of space activity. The goal was never only scientific glory. The goal was to create a private market big enough, profitable enough, and technologically capable enough that space would stop depending entirely on public budgets and become an economic frontier in its own right. SpaceX became the clearest proof that this vision could work. That matters enormously. And the reason it matters is simple. Capital does not fully commit to a new category because of speeches. Capital commits because one player becomes so large, so dominant, and so undeniable that the rest of the ecosystem suddenly looks real instead of theoretical. That is what a company like SpaceX does. It stops being a story and becomes a category, defining event. That is the mother line for this entire subject. Do not wait for the rocket. Own the rails that become more valuable the moment the rocket proves the market is real. This is not a small distinction. The crowd thinks in terms of symbols. An allocator thinks in terms of systems. The crowd says, "When does SpaceX IPO?" The allocator says, "If SpaceX IPOs, what else gets de-risked, revalued, and pulled into institutional view?" That is a much better question. Now let me show you why. SpaceX is not just a launch company, it is a signal flare. It says private space can generate real revenue, real market share, real margins, real infrastructure demand, and real strategic gravity. It says that what began as speculative capital in a futuristic sector is maturing into something institutions can underwrite without sounding unserious. Once that happens, the entire conversation changes. Analysts start building broader models. Funds that could not justify the category before can now justify it. Passive and thematic baskets expand. Liquidity arrives. Valuation frameworks become more generous. Supplier chains get repriced. Adjacent names get noticed. And all of a sudden, the market is not just buying a rocket company. It is buying the idea that private space is an investable ecosystem. That is the second rule. A giant IPO does not only reprice itself, it reprices belief. Belief is a very powerful thing in markets when attached to categories that previously sat on the edge of respectability. I have seen this in other sectors. One company comes along and proves that what looked like a niche is actually the first large commercial winner in a much broader field. Once that happens, money begins moving not just into the winner, but into the roads, pipes, chips, software, logistics, and infrastructure around it. The clever investors are not the ones who say, "I hope I can buy the winner on day one." The clever investors are the ones who already own the surrounding system before validation arrives. That is how I want to frame the 5 stocks in this story, not as random tickers, not as a shopping list for people with attention problems, as 5 different rails in a launch chain. 5 different ways to get paid if private space shifts from fascinating to foundational. Let us start with Rocket Lab, because this is the clearest rail of them all. When people hear SpaceX, they think scale, spectacle, launch dominance, vertical integration, mission ambition, moon, Mars, Starlink, all of it. Fine. But once you understand that SpaceX can validate the broader category without needing to personally own every mission forever, the second launcher suddenly becomes very interesting. I do not need Rocket Lab to become SpaceX. That is the wrong framework. I need Rocket Lab to become the obvious number 2 in a world where the whole launch economy expands dramatically. That is a much easier job, and easier jobs are often more profitable than glamorous, impossible ones. Rocket Lab is not competing for mythology, it is competing for business. A business with increasing launch cadence, increasing demand for satellite deployment, increasing need for orbital infrastructure, and a future where every serious participant in the space economy needs regular, reliable commercial lift. That is a real market. The company already has revenue. That matters. It already has customers. That matters. It is accelerating launch pace. That matters. It is not merely promising that one day a rocket may work. It is already participating in the market and trying to climb toward profitability as the entire category scales around it. This is the first mechanism I want you to remember. I call it validation spillover. Validation spillover is what happens when the success or public recognition of the dominant player makes the entire category more credible, reducing skepticism around second-tier players that are already delivering real services. The leader does not need to lose for the next serious player to win. In fact, the leader often helps create the conditions under which the next player becomes investable. That is Rocket Lab's opportunity. A rising tide does not need to make every boat identical. It only needs to make more trips economically worthwhile. And once you understand that, the usual retail obsession with who is the best starts to look childish. The better question is, which company is already in position to capture category expansion with the least need for fantasy? Rocket Lab answers that question better than most names in the sector. It is still speculative relative to an old industrial company, of course. I am not foolish. But compared with many space names, it is much closer to adult reality. Revenue is real. The backlog is real. The cadence is real. Profitability is near enough to matter. And the entire logic of the business becomes stronger if the private space industry gets more institutional money, more missions, more customers, and more urgency around orbital and lunar infrastructure. That is why I like it. Not because it is a meme, because it sits on a real rail. Now let us move to a very different kind of rail, AST SpaceMobile. Rocket Lab is about getting things into space. AST is about making what is already in space economically useful to everyday life, in a way ordinary people can actually feel. That is important because industries get much larger when the abstract becomes personal. The market may respect rockets. It grows much larger when ordinary people feel the product in their pocket. The promise here is global cellular connectivity through space, not in the science fiction sense, in the practical sense. A phone that works where the old network ends. A communication layer that does not stop just because geography becomes inconvenient. That is a huge promise if it works at scale. And that phrase matters, if it works at scale. A great many investors fall in love with concepts because concepts are clean and exciting. They forget that concepts do not generate revenue. Execution does. Constellations must go up, contracts must be secured, partnerships must hold, delays must be managed, cash burn must be survived. The technology must prove itself outside the pitch deck. That is why AST is riskier than Rocket Lab. It sits earlier in the proof chain. But its upside is also enormous for the same reason. If the product truly delivers and the constellation reaches the point where revenue begins climbing in earnest, then the market will not think about this as a neat story. It will think about it as a new communications layer. That is a much larger thing. I call this the proof to scale gap. The proof to scale gap is the stretch where a company has shown enough technology to excite capital, but has not yet built enough operational scale to make the revenue story feel fully inevitable. Stocks in this gap can move violently because the market alternates between seeing the end state and remembering how hard the middle is. That is exactly what creates the opportunity. AST has already de-risked parts of the story. The technology is proving itself. Partnerships matter. The launch path exists. The market can see what the company is trying to become. What it cannot yet do is fully price the end state with confidence, because execution still stands between here and there. That is fine. I have no issue owning execution risk in limited size when the category runway is long enough and the payoff is large enough. The crowd wants certainty. Certainty is usually expensive. If the company gets there, if the constellation ramps, if the service becomes more than an engineering experiment and turns into a global product layer, the current discomfort will have been the whole reason the price was attractive in the first place. That is what good growth investing often feels like, not safety progress through doubt. Now I want to move to a third rail that many people misunderstand because it sounds more speculative than it really is: intuitive machines. When most people hear moon economy, they either laugh or get mystical. Neither reaction helps. I prefer to think in contracts, services, engineering, hardware, and the sequence by which space activity moves from symbolic missions to recurring economic function. That sequence matters because markets pay differently depending on where a company sits in it. Intuitive machines is not merely a story about planting flags and taking pictures. It is a company tied to the practical machinery of lunar activity, landers, robotics, services, engineering, government, and defense relationships. Components of a broader lunar infrastructure chain. People often think the value is in the giant iconic event. I think the value is in the repeated service. That is why I respect this setup. If the next decade really does involve more serious lunar work, more transport, more mission layers, more coordination between public and private actors, more hardware in harsh environments, more attempts to build a real cislunar and lunar operating presence, then the firms that provide necessary tools and mission components can become far more valuable than the market currently assumes. This is the third mechanism. I call it mission persistence. Mission persistence is the economic value created when a company is not dependent on one symbolic breakthrough, but instead supplies recurring services or hardware to a mission category that expands over time. Markets often overprice the first event and underprice the businesses that get paid again and again. If the event becomes routine, that is what makes intuitive machines worth studying. Revenue growth is there. Profitability is closer than in many other space names. The market has begun to notice. The chart has improved. The stock is trying to move from a speculative range into a more serious revaluation zone. And importantly, the business is not purely dependent on one lunar fantasy. It already derives services and engineering revenues from broader government-linked work. That matters because it gives the company something to stand on while the bigger lunar thesis unfolds. I like that. A business should not need the whole dream to arrive tomorrow in order to justify itself today. The stronger setups can survive the waiting. Now let us move to Planet Labs, because this is a subtler rail and one the market tends to treat unfairly. Planet Labs sits in the category of companies that make space useful by turning satellites into data infrastructure, Earth imaging, monitoring, information, intelligence, observation. This is not the same kind of glamour story as launches or moon landings, which is precisely why I find it interesting. Markets have a weakness for spectacular narratives. Real money often gets made in the quieter infrastructure that becomes essential once the spectacular narrative normalizes. That is what Planet can become. Its role is not to dominate launch. Its role is not to dominate lunar transport. Its role is to convert orbital presence into information services people will pay for repeatedly. That is valuable. But there is an important caveat. Profitability is farther out. The runway is longer. The market is more impatient. That means the stock is more exposed to sentiment swings because the bridge between useful business and high-quality profitable business is longer. I respect that risk. I do not ignore it. This is why I think of Planet Labs as a second-order beneficiary rather than a pure first-order play on the SpaceX event. It is not merely that Planet uses SpaceX as a launch path. It is that a healthy, better funded, more institutionalized space economy makes businesses like Planet easier to understand, easier to fund, easier to value, and more likely to attract patient capital. I call this category uplift. Category uplift is when a rising tide of institutional respect for an entire sector improves the financing conditions, valuation tolerance, and strategic visibility of smaller companies whose direct economics may still be maturing. The company has not fully changed yet. The category around it has. That can still be very valuable. Planet's chart matters here. Institutional ownership matters. Support levels matter. The market is telling you that serious money is willing to sit in the name even though near-term profitability is not around the corner. I always pay attention when the chart begins acting stronger than the financial headlines alone would suggest. That tells me the market may be pricing not the current earnings profile, but the shape of the eventual business. That is what you want to see in an earlier stage rail. Finally, let us talk about Redwire because it may be the most abstract and therefore the easiest for ordinary investors to ignore. That is usually where bargains hide. Redwire lives in the category I think of as orbital scaffolding. If you are going to do more in space, not just visit it for spectacle, but actually use it for manufacturing, infrastructure, energy structures, assembly, and more durable industrial functions, then someone has to provide the components, structures, and enabling systems that make that possible. This is not a business. Most people can visualize easily, which is why the stock has lagged and the setup looks weaker on the chart than some of the others. I do not blame the market for being cautious. The timeline to clean profitability is longer. The proof chain is less emotionally obvious. The near-term catalysts are weaker. All of that is true, but none of that means the rail is unimportant. This is where people miss the point of system investing. They want every part of the chain to look beautiful at the same time. Real ecosystems do not work that way. Some parts get recognized early, some later. Some need a flagship event to change how the market thinks about them. Redwire is one of those. If capital floods into space after a major IPO and the market begins taking seriously the idea of larger orbital infrastructure, solar arrays, manufacturing systems, habitat components, and all the unattractive but necessary structures that a real space economy requires, then Redwire can be revalued by the category before its current financial profile would ever justify the move on its own. That is the point. It is not a current beauty contest. It is a system role. I call this the hidden necessity mechanism. The hidden necessity mechanism is when a business that looks secondary or obscure becomes strategically important because the larger industry cannot scale without the kinds of components or infrastructure it provides. These businesses often look weak until the category forces investors to realize how indispensable they are. That is why I would not treat Redwire the same way I treat Rocket Lab. The role is different. The confidence level should be different. The position size should be different, but it still belongs in the conversation if you are serious about understanding the full launch chain rather than merely buying the most obvious names. Now step back with me. Rocket Lab AST SpaceMobile. Intuitive machines, Planet Labs, Redwire, 5 rails, 5 different positions in the launch chain, 5 ways to get paid if private space moves from exciting to institutional. That distinction is everything. If you only see these as 5 tickers, you miss the whole point. The real point is that the SpaceX IPO does not just create a tradable event. It creates a legitimacy shock. And legitimacy shocks are very powerful in markets. They change valuation frameworks. They change who is allowed to buy. They change what seems prudent. They change which sectors suddenly become respectable enough for serious money. That is why I do not care much about buying SpaceX at the open. Maybe it will be a wonderful investment. Maybe the first trade will be ridiculous. Maybe the first week will be glorious. Maybe it will be a circus. I do not know. What I do know is that once the market gets the rocket, it will start looking harder at the rails. And by then, I would prefer to already own some of them. That is the identity shift in this entire story, from event chaser to launch, chain owner. That is the flip. An event chaser asks when the IPO is. A launch chain owner asks what the IPO validates. An event chaser wants the opening pop. A launch chain owner wants the multi-year repricing of a whole ecosystem. An event chaser stares at the rocket. A launch chain owner gets paid by the whole countdown. That is a far more durable way to think. Now, I am not telling you to be reckless. These are not all equal. The risk profiles differ enormously. Rocket Lab is not AST. AST is not Intuitive Machines. Intuitive Machines is not Planet Labs. Planet Labs is not Redwire. Each sits at a different stage of proof, a different distance from profitability, a different degree of dependence on category uplift, and a different sensitivity to execution. That is why the correct answer is not buoy everything. The correct answer is to understand what kind of rail you are buying and why. This is the operating system I would use. First, separate the rails by proof stage. who already has real revenue, who is near profitability, who is still building the bridge. Second, separate them by role: who launches, who communicates, who services lunar activity, who monetizes data, who builds infrastructure. Third, ask what happens to each. If the SpaceX IPO validates the category, but the stock itself becomes too expensive to buy rationally. Fourth, size the positions according to proof, not excitement. Fifth, remember that the best outcome may not be buying the most famous name. It may be owning the less obvious companies whose entire valuation framework improves once the famous name changes the market's mind. That is how I would play this, not with hero worship, with systems thinking, because markets are full of people waiting for the next big event. Very few people stop to ask, who gets paid before the crowd realizes the event changed the economics for everyone connected to it. That is where I like to live, on the rails, not on the rocket.